right, well, welcome everybody. Thanks for being here. I'm Brian Jacobsen. I'm the Chief Economist at Annex Wealth Management. So really delighted to have you here. This is my first time in the Italian Community Center, believe it or not, even though I was born and raised in the area. I can't believe I've never been in this building. So this is kind of exciting for me to be here. One of the things that we wanted to really share, big questions that we get from clients oftentimes is, how can you make your cash work harder for you? And then also, how can you have like a framework for thinking about putting it to work? So not just making it work harder for you right now, but then also getting it back into the markets more aligned with your longer term financial goals. And so that's what I want covered here. It's kind of an approach to thinking about some of those topics. So that's why this is cash on the sidelines. How to make it work. I wanted to call it, make it work smarter, not harder, but that sounded a little bit too cheesy to our marketing people. So that's why we have the title we do. I have to start with some obligatory disclosures, since we are in a heavily regulated industry. Don't worry, I'm not going to quiz you on this. The gist of it is, if anybody asks, I was never here. And if they claim I said anything, I will deny it. But no, basically, remember, this is not customized advice to you. We need to sit down and walk through your financials, come up with something really personalized. And so this is for educational purposes. There will be some data points in here. Remember, they're basically like screenshots and data points as of the last couple of days. So if you're kind of jotting down notes and you look at this, even a week from now, those numbers probably have changed. Okay, so keep that in mind when you're looking at some of this. So cash, what is it? Okay, well, a lot of times in the financial media, when they talk about cash on the sidelines, they're not talking about literal cash. The currency in your pocketbooks, or even the money necessarily in your checking account. It's a little bit broader of a concept. Cash is really referring to one or a combination of these 5 things. Okay, you can have your physical cash. Did you know that there is approximately $8,700 in cash per person in circulation? Now, I don't know of anybody who walks around with that sort of cash, or even if it's buried in their backyard or in their underwear drawer or wherever it is at home. Most of the cash that's in circulation is actually, especially large denominations, $50 bills, $100 bills, are outside of the United States. Okay, so we provide cash to a lot of other countries because they might be in a country like, say, Ecuador, where they've actually adopted the US dollar as their currency, and so they use cash, US dollars, in circulation. It is also oftentimes in areas, lesser developed countries, where they don't necessarily trust the cash that's printed by their own governments, and so they will use US dollars instead. So physical cash is a good chunk of the cash, the total of cash. The bulk of it, though, is really in those other categories. Your checking accounts. Go to the bank, right? You can write checks, very useful. It's not literal cash, but we consider it's close enough. It's cash equivalent. Then you have savings accounts as well. In terms of the amounts that are actually out there, checking accounts are about 1/10 of the amount that's in savings accounts. Okay, so it's almost like you go from the amount of physical cash, multiply that by 10, that gets you about how much is in checking accounts, multiply that by 10, that's how much is in savings accounts. A lot of money, though, has gone into money market accounts. You can get money market accounts from your bank. You have the money market demand accounts. You can also get money market mutual funds. Somewhat similar, but very different, especially in terms of the protections that are offered to them. If you put money on deposit at a bank in a money market deposit account, you have that FDIC guarantee, right? The Federal Deposit Insurance Corporation. So they protect the value of that is in that account. Whereas if you put it in a money market mutual fund, it doesn't have that FDIC guarantee. They do keep, it's heavily regulated, securities, through the Securities Exchange Commission. The value is usually pegged at $1, so very predictable, the amount that you'll be able to get out. But they are somewhat different in terms of the protections. That also means that there's a little bit difference in terms of the risks, and also in terms of the yields that are on offer. in my view, those yield differentials can be enough to really justify those risks. Okay? So you have the money market accounts, and then you can also get into short-term fixed income. Like if you want to purchase treasury bills, like a 3-month treasury bill, 6-month, 12-month, you can even purchase municipal bonds that mature within a short period of time. Okay, those are some of the short-term fixed income instruments that are sometimes included as part of cash. So that's kind of what we'll be talking about mostly, is how to make this work harder, but then also how to move from cash into other parts of the markets like stocks, bonds, maybe align more with your longer-term financial goals. Okay, so as we go through, just ask questions. You don't even have to raise your hand. We don't have to treat it like it's a classroom or anything. So just, you don't have to save it until the end, just ask questions as we go along. So anything so far? All right. Now, in terms of why do you hold cash? Biggest reason, economists, the way that we look at it is there's kind of 3 primary motives for holding cash. First is you want to do transactions. Right? You have bills that you need to pay. That clearly is, so we would call that liquidity needs. It's liquid in the sense of it's easy to flow to somebody else, right? It's in your pocket, and then you can purchase groceries, you can pay the electric company, companies, or you can pay your employees, you have your working capital. So working capital for businesses is part of the liquidity needs and one of the desires for holding cash. Another is you don't necessarily just want to hold cash for transaction purposes that you have planned. There are a lot of things that happen in life that aren't planned. You might have the tire that needs replacing, pipes that burst as a result of the cold weather, right? And unfortunately, if you lose electricity. So you might want to have some for like a rainy day fund, or you might have some that aren't for immediate transactions, but you want to budget it because you want to take that trip to Barcelona, right? You want to save up over the course of time. You know you're going to have a financial need, a need to buy something over a period of time, and so you kind of want to put aside a little bit of money periodically in order to make sure you can make those payments. That would be called the precautionary balances. For most people, the cash, they really focus on the liquidity needs, and sometimes they kind of forget about, you might not want to put your rainy day fund in Bitcoin, something like that. There's a lot of volatility there, so you want some predictability, but the precautionary balances, that's the kind that maybe you can put it in something that isn't sitting in a 0 interest rate checking account. Maybe it can go into a savings account, maybe some certificates of deposits, or into money market mutual funds, or even other types of instruments that have a little bit more predictability. You can tolerate some variability with the value of it, okay, but not necessarily a lot. And then the final motive for holding cash is it's an investment. It really can be. Over the last year, you've been able to get the money market accounts 5.5%. That's not bad, right? If you think about the long-term return on bonds, like long-term bonds, it's around 6 to 7%. Well, you're able to get that by sitting in a money market account. So that's not a horrible value proposition right there. So, cash itself can be an investment. There can be an investment. There wasn't a huge demand as an investment when the Fed had interest rates pinned at 0%. But now that they're up, the Fed is targeting between 5.25 and 5.5% for the federal funds rate. It actually does become a legitimate investment. I think that there might be better investment alternatives, but it's not a horrible place to be. All right, now in terms of how to make it work, one way to think about it is in terms of the predictability of the value, so the risks, so that would be on the bottom there, and then the expected returns. If you are in a checking account, it's probably like 0% expected return and 0 risk. You know what the value is going to be. You can just log into your app, check whatever it is one day, as long as you haven't spent it, right? It's there the next day, exact same value. Now, some banks do offer interest on checking accounts. Right? If you have a high enough balance, good enough relationship, whatever, but for the most part, the expected return on it is pretty close to 0. But that's where you're keeping money as far as for your immediate liquidity needs. You could do a little bit better than that, right? Maybe you can get a slightly higher expected return by going into a savings account. Right? Now, one of the challenges with the savings account, it's not quite as accessible. Maybe it is, you can't write checks out of your savings account, but you can transfer the money into the checking, usually very easily. It used to be, so I started in the financial services industry working at a bank as a teller while I was in high school, and it was a lot of fun. So I got to learn all about all the restrictions on the accounts. And at that point, we had a restriction where you couldn't do more than 6 withdrawals per month. Okay. So with a checking account, as long as you had checks, you could keep writing them. Hopefully not for more than what was in there. Just because you have checks left doesn't mean that you have money left in the account. That was a hard lesson that some people had to learn. But with checks, pretty much unlimited. Now, in some accounts, you do have to pay. We had one type of account where you had to pay per check. We charged 50 cents per check. So now, thanks to competition and technology, a lot of times those types of accounts have gone to the wayside. But with savings accounts, sometimes it's unlimited as far as the transfers that you could make or withdrawals, or they might limit it where it's a certain number per month. But you can get a little bit more return by having the money sit there. But you can do even better than that. Right? Perhaps instead of a savings account, you can get higher return by going into a certificate of deposit. Right? Now, a challenge with the certificate of deposit is that is for a specified term. Maybe it's a 3-month certificate of deposit, maybe it's a 5-year certificate of deposit. Okay, so it's money that is supposed to be locked up. You get a return for that for agreeing to have it locked up. And you don't have as much liquidity. So there is actually a bit of a risk in terms of your need for it. So perhaps instead of having it go straight up there, right, there is that risk that what if you need the money? Okay, so for a CD, a little bit more risk, a little bit more return. You can oftentimes take the money out, but then you have to forego some of the interest. So they aren't necessarily going to penalize you in terms of, oh, you put in $10,000, you can only get out 9. It's just you would have to forego some of the interest on it. So CDs, you could also get money market, so MMDAs are the money market deposit accounts from banks. Again, very low risk because you've got that FDIC guarantee for $250,000 per account holder. So if it's a joint account, you get to double that. So for $500,000 guarantee from the government. And you can oftentimes get a slightly better return. Now, alternatively, you can go even higher, and that would be with the money market mutual funds. Okay. So those don't have the FDIC guarantee wrapper, but they are oftentimes very well managed in such a way and heavily regulated by the Securities Exchange Commission, such that you don't have to worry too much, you don't have to lose sleep over the value fluctuating. You can oftentimes get a higher yield. Now, sometimes there was an instance during the global financial crisis, if you remember, where one of these money market mutual funds did break the buck. Okay? And that's just a technical way of saying that most money market mutual funds, they peg it at $1, and so if the value deviates from $1, that's called breaking the buck. It didn't break the buck by a lot. In fact, the company that was managing that fund, they were the oldest money market mutual fund in the United States. It's just they kind of mismanaged it a little bit. They took on a lot more risk than what was probably prudent, and people started to panic. As a result, the federal government stepped in, and they actually gave FDIC-like guarantees to money market mutual funds. So in the event of a crisis, it's almost like kind of in case of fire, break glass. Right? You had a bit of a fire there, they broke the glass, and the US Treasury decided that they were going to guarantee the values of the deposits in money market mutual funds so people wouldn't panic and start withdrawing money very rapidly. My guess is, if we have another kind of crisis, they'd probably do something similar. They already set the precedent for that, but of course, there's no guarantee of that. So money market mutual funds, incredibly safe. Okay. They also often allow you to write checks out of them depending upon the provider. Okay. So another way that you can kind of move out on the spectrum, a little bit more risk, but a little bit more expected return, would be some of those short-term fixed income instruments. Like you can own treasury bills. The values do fluctuate though on a day-by-day basis. And so that you do have some of that variability, and that's the risk in it, is that if you own, for example, a 3-month treasury bill, that means that you put in $100, okay, and technically you would buy it at a discount, so you might pay $99, and then the government guarantees you'll get $100 in 3 months. Okay. That $99 that you paid, if you try to sell it early, maybe you only get 99, or you get 98.9, or you get 99.1. So a little bit more, a little bit less. So you do get some of that fluctuation. You don't get that fluctuation with these other instruments. Okay. So a little bit more type of risk, but associated with it, a little bit more expected return. So it's not, investing and managing cash, it's not just about the risk, the variability in the price or the returns. It's also about some of these other issues, right? How accessible is it? Can you write checks? Can you do ACH? Can you do wire transfers? How predictable is the face value? What are the different protections? So you have FDIC as a protection for anything deposited at a bank. If you have a brokerage account, that brokerage account is going to have SIPC insurance, which is different. It's the Securities Investors Protection Corporation. And they will actually guarantee that you can get the securities back. They don't guarantee the value of the securities, but if anything happens with that brokerage, like let's say if you have in a brokerage account some Apple stock, and the brokerage, they go bankrupt, the SIPC says you can get that Apple stock back. They won't tell you, guarantee what the value of it is, okay, but at least you can get the securities back themselves. Money market mutual funds are treated like securities for purposes of SIPC. So you would be able to get the shares back anyways. They don't guarantee what the value will be, okay, but they do guarantee that you would at least get that number of shares back. Another important feature too that I think is worth considering with cash is the consumer protections. This is especially relevant to if you are thinking about, should I use a debit card or a credit card for a transaction? If you use a credit card, right, you're going to get a bill and you're going to have to pay that back out of your cash. So a credit card isn't cash, but it is actually, it's a form of debt. It's a payment method, but there are lots of consumer protection that if there's fraud, if there's something that you buy and the merchant hasn't delivered it, the credit card company is legally obligated to help you out. You don't have to pay for it. If you use your debit card, which gives direct access to your bank account, you are on the hook for that money until it gets resolved. So whenever you have to choose between a debit and a credit card, as long as you can be very responsible about the use, I usually recommend a credit card. You can also get points. That's also a nice thing.
Brian, if I can maybe, you and I did this presentation last night, and we had a lot of questions about really where, what are the instruments that people could go into. And, once we opened that question up, as you know, it was flooded, right?
Yes.
And they weren't debit card questions. They were, where can I get a better return right now? What should I do with it? Should it be in fixed income? Should I lock in rates, dividend stocks? I think people would have to be interested in that response.
Sure. Yeah. So right now the way that we're doing things on our investment committee, thinking about it, is the Federal Reserve has been hiking very rapidly with rates, but we know based upon everything that they have said that they're probably done for the most part. Right? We don't have to worry about next week, Wednesday, when they meet, that the next move is going to be a hike. The question is, when are they going to start cutting? It's not going to be next week. I highly doubt that. I mean, maybe they could, right? I can't guarantee that, but it would be highly unlikely for them to actually start cutting next week. Most likely, what they are going to do is signal that they are getting ready to cut. What they probably want to do is stop shrinking their balance sheet. So what the Fed did during the COVID crisis, right? They bought a lot of stuff, a lot of government bonds, corporate bonds, things like that. So they expanded their balance sheet. Okay, and they have been tapering or tightening. They've been shrinking that balance sheet. They're probably going to slow the pace of that tightening, and that is likely to happen not necessarily next week, but they'll tee that up for the following meeting, which is then in March and beginning of April. And at that meeting, they'll probably say, you know what, the inflation numbers are headed in the right direction. Are we at the destination we want to be at? No, but we're headed there. And as a result, they'll probably have to start cutting rates in June. They're likely going to take it very slowly and methodically. The pace that they went as far as hiking rates, right, it went up like that. And then as far as what is it going to look like as far as going down, it's probably going to be a very gradual off-ramp. And what that means is that when we consider some of the other investment alternatives, when we're at this point here, right, suddenly you're looking ahead, those cash yields, money market mutual funds, savings accounts, those rates are likely to follow it lower. And so if cash, which you can make hay while the sun is shining right now because the yields are high, it's not likely to stay that way for very long. And so at what point do you then try to lock in those yields? And so what we've been doing over the last, say, month or two is beginning to move out into longer term fixed income. If you think about what happened with the 10-year Treasury yield, which is a good barometer for some longer term yields, the yield when the Fed had rates pegged at 0, right, you still did have a positive yield. And then as the Fed was hiking rates, this yield went up. Suddenly you went haywire a little bit back in between July and October, but it has begun to drift back down lower. And it will likely come down. So there isn't necessarily a sense of urgency where immediately we feel like we have to lock in those yields, but we do want to do it methodically. Almost, if you've ever heard of like dollar cost averaging with investing, dollar cost averaging out of cash more into bonds and other instruments that also provide yield. So treasuries are, of course, one of the examples. Corporate bonds are another. You also have preferred stocks, dividend-paying stocks. So if you're looking for income, you don't want to be looking for income in all the wrong places. Right? And I think that's there was a song that sounded a little bit like that, as far as looking for love in all the wrong places. And you don't want to be looking for yield in all the wrong places. The places where you can find decent yield that is likely significant and sustainable, that's really what we're trying to identify. We're finding that still in investment grade corporate bonds, preferred stocks, and equity income kind of strategies, dividend paying stocks. Okay, because these yields are likely going to drift lower as the Fed hikes, and we don't want you feeling like you missed the boat, right, as far as locking in those longer term yields, because they are likely to start drifting lower. Okay. Now, when you're looking at these things though, remember the taxes. A lot of times people just look at the advertised yields. Maybe it's a dividend yield on a savings account, and they're saying, oh, that's great. But that's not necessarily what you get to walk away with. You know, the federal government, they want to take their cut. The state government wants to take their cut. So you do have to be aware of how are these different types of vehicles taxed. The interest income, for example, on a savings deposit, you have to pay tax on that both at the federal level and at the state level. Okay. Same thing applies to a corporate bond. If you purchase a corporate bond that's issued by, say, General Electric, We Energies, the income that you get, you're going to have to share some of that with both the federal and the state government. So you want to think about these things after tax. Now, maybe you could actually own that bond instead of in what's called a taxable account. Own it as part of a qualified account, like in a 401k or an IRA, something where you don't have to worry about the taxes. So that's where we talk a lot about not just asset allocation, about how is it that you allocate between cash, stocks, bonds, but also asset location. Because you want to use the right tool for the right job in the right place. Okay. And so corporate bonds, fixed income, things like that, oftentimes are best held in qualified accounts. Okay. If you have a taxable account, that's where municipal bonds can be much more interesting, or municipal money markets, because those aren't taxed at the federal level. It might be taxed at the state level. If you can find Wisconsin state government issued bonds, you don't necessarily have to worry about the federal taxes or the state taxes. But our government actually has been running a surplus. There aren't a lot of those bonds available. And so most people in Wisconsin, when you're buying municipal bonds, you're buying bonds that have been issued by Illinois, Texas, California. Okay. Those are taxable at the state level. Okay. They aren't taxable at the federal level. And that could be pretty huge as far as the savings. If you think about, if you're in the top tax bracket, right now that's 37% at the federal level. There's also this thing called the net interest income tax, which is 3.8%. So if you're at that top level, you not only pay 37% on your investment earnings, you pay that additional 3.8 for a total of 40.8%. So that's a huge amount that you get to, you're going in partnership with the government, basically, when you're making investments. Not necessarily always the best partner to have. Now, at the state level, right, the top bracket in Wisconsin, I think, is at currently 7.65%. Right? So you add those up, I mean, you're pushing, nearly 50%. You might want to hold those instruments that are taxable, fully taxable, in something that is tax preferred, which is like an IRA or 401k or something like that. Okay. So that's something to really be aware of. If you have a money market fund, if it's a government money market fund, so what they do is they invest in treasury bills, government debt in general, that income isn't necessarily taxable at the state level, but it is at the federal level. So it gets complicated, right? It's almost like this multi-dimensional game of chess that you have to play when you're kind of thinking about asset location, allocation, all the tax implications. So very important. This is where a lot of people might like to hold something like dividend-paying stocks, because if you hold the stocks, hopefully the prices go up, right? So you have to be aware of capital gains, and if it's short-term capital gains, that's almost as though it's ordinary income. That's at the top marginal rate. But if it's long-term, if you hold that stock for 1 year plus 1 day or longer, it suddenly gets treated like it's long-term, in which case it's, if you're in the top tax bracket, 20%, plus that 3.8% surtax. So it's like a 23.8% tax. So if you can hold stock and you hold it for 1 year plus 1 day or longer, you can get a much better after-tax return. And if it pays dividends, as long as you've held the stock for 60 days, you get a preferential rate as far as the dividend that it pays out. Okay? It's taxed as though it's almost at those capital gains rate, the long-term ones, the 20.8. So instead of being treated as ordinary income, the 37.5%, you could actually, with the dividends, get it at the much lower tax rate. So one of the reasons why a lot of our clients are really interested in dividend-paying stocks. But you do want to be careful, because if you're just looking at the dividend yield, you have to wonder how sustainable is that dividend yield. Just because it was high doesn't mean it will be. What if they cut that dividend? Or maybe the company is kind of going down the tubes. You do have to still do your due diligence to make sure that it's a good investment. Now, just as far as want to highlight some kind of real-world examples as far as how to think about some of the opportunities, it really pays to shop around. This is, if you have never gone, go to bankrate.com. It's a great website as far as trying to comparison shop as far as yields. You can also look at mortgage rates and things like that. This was pulled from 2 days ago as far as the yields that were on offer. You can find some high yield savings accounts, 4.35 up to 5.1%. I'll be perfectly honest, I have never heard of some of these banks, but that's why you always look at, all right, is there that FDIC guarantee? Maybe you can sleep a little bit better at night. Just don't put in more than the $250,000, whatever the coverage limit is. But that's what you can get from some of these banks. But now look at the yields that were on offer as far as banks nearby. I don't know why it identified the Bank of America branches nearby to me, because nowhere close to where I was, but those were some of the yields on savings accounts. So which would you rather have? So it pays to shop around. Banks do like to take advantage of inertia and the fact that people don't really shop around. So it can pay to do some of that shopping around. Same thing as far as when you're looking at money market accounts. If you look at, say, this one here, a money market deposit account at a bank, it's FDIC guaranteed, 5%, not bad. Compare that to what you can get at your bank. At some of those other banks, you can also look at certificates of deposit, like a 3-month yield of around 5%, 4.5%. And my grandfather, when they sold their farm back in 1979, they got $1 million. That was a lot of money. And what they lived on from 1979 until when he passed in 1999, for those 20 years, he basically just shopped around for CDs the entire time. He never once owned a stock. He never once owned a bond. He would just go around to the local branches in Winnie County, Wisconsin, and try to find out who had the best CD rates. And that's what they lived on. They didn't live an extravagant lifestyle by any stretch of the imagination. But people were able to do that. You haven't been able to really do that much lately. But now you can actually get some pretty decent yield on these CDs. Even some of the longer ones. An interesting thing though is the short-term yields. So the 3-month CD, 5%, whereas a 5-year CD, 4.6%. It's a lower yield. But what you do is you lock in that longer-term rate. Because if yields over the next 5 years, if we go from 5% down to 2.5%, right, the average is going to be somewhere close to around like 3.5%. So if you just try to roll these CDs on a 3-month basis, there's what's called reinvestment risk. Okay, and that's the benefit of locking in those longer-term yields. Keep in mind, again, though, these are CDs. So they're not the most exciting things. Maybe that's fine, helps you sleep at night, but these are also going to be fully taxable at both the state and the federal level. You can also get a little bit more yield if you look at money market mutual funds. Okay, so these are from 2 custodians that we work with, high quality, offer a great range of services, very low fees. It's one of the reasons why we work with them through Fidelity and Schwab, where they have different types of municipal, or they have different types of money market mutual funds. You have municipal ones, so those are free of federal tax, not necessarily state tax, okay, because they are investing in municipal bonds from outside of Wisconsin. And so the yield looks awfully small, 2.35%. But if you compare that to, okay, well, after tax, because you don't have to pay the federal tax, then it's 2.17. Not exciting, but not too bad. Then you compare that to, let's say you go into a government money market fund, stated yield 4.98%, but it's taxable at the federal and not the state level because it's holding federal government debt. Well, the after-tax yield is 2.95. So you kind of have to do your comparison. Right. It's still, in this case, you might want to pay the taxes because the yield is going to be high. And this is the type of analysis that we do with clients all the time, is finding out where is it that we can make your money work hardest for you. And then also, next is how can we get the money to work harder for you by getting more into fixed income and equities. And this is kind of a framework that we use in order to think about budgeting. Really, it's putting financial planning first as far as budgeting. What are your monthly expenses? Let's figure that out and think about putting that into a liquidity bucket. This you probably want to be incredibly safe, right? As far as in a checking account, a savings account, money market mutual fund, your liquidity bucket. The things that you're budgeting for as far as longer term. So if you kind of think about, let's put anywhere from 0 to 12 months worth of spending in that liquidity bucket. Then a precautionary bucket, let's think about anywhere from 12 months, depending upon how risk averse you are, maybe up to 7 years. Okay? Or maybe it's as short as 3 years. That's more the shorter term fixed income. Make it a little bit, work harder for you. You can tolerate a little bit more of that risk, get a little bit more of that return. And then the rest of it, think about that growth bucket, which is more that mix of stocks and bonds as far as whatever that strategic allocation that you want. Now, one of the tricks though is once you've determined how to do the allocation, is refilling your buckets. Right? It's one thing to have it, but then to make it come alive, what happens when this liquidity bucket, it's here and suddenly, you're draining it. At what point do you start filling it up? Well, if you're working, your paycheck is going to help fill up that bucket. Social Security, that can help fill up the bucket. If you have more, right, then it's about looking at opportunistically, maybe refilling it from the precautionary bucket. So tip that bucket into the liquidity bucket. Yes?
I have a question. Maybe it's for the rest of the Annex gang. Of your clients, over the last several months, what percentage of their total assets are in cash? The range?
Oh, that's a great question. There's such a variation. Dave, I don't know if
Yeah, generally, we generally keep about 1%, but we've gone up to as high as 20%.
Yeah.
But I think it would be interesting not only how much cash is on the side, because we manage the money in the aggregate, right? Is what goes in those buckets? What are the instruments that go in each one of those buckets?
Yep. Yeah. So, and just for some perspective, nationwide the average is like 10%. That's for the entire country. For us, it's a little bit different because it can also be an investment. So, as far as the liquidity bucket, obviously, this is one in which what do you have in your checking account? What do you have in your savings account? This is not a place that I would put certificates of deposit, okay? Because those you need to have locked up, unless you're thinking about there are what are called brokered CDs, which are through a brokerage firm where you might be able to buy and sell them. Okay, but typically this is very safe, and your money market mutual funds. So money market mutual funds. And we tend to put more in the money market mutual funds than in the savings account because the yields right now are so much better compared to 0.01% that you can get on Chase or Bank of America versus something closer to 5% from a Fidelity or more than that from a Schwab. Right? So that's what we would put in this liquidity bucket. What we oftentimes do with the precautionary one then, depending upon the client, is this could be a bond ladder, okay, where they own the individual bonds. So it could be a 12-month treasury bill, or it could be a 12-month piece of debt that has been issued by Apple. We're pretty confident Apple is going to be able to pay that. And so you can create a ladder where it goes from anywhere from 1 to say 7 years, so you know predictably that when it's going to mature. And so it's about structuring it so that way you have them maturing and paying off when you need it in order to then periodically refill that liquidity bucket. Just as an example of that, it would be like, let's say you have a mortgage, and if you know that your mortgage is going to be, let's just say for the whole year ahead, $30,000. Okay, so divided by 12 as far as your monthly payments. You want to buy a bond that's going to mature just before the beginning of the year that's worth $30,000, the face value. So you can buy that, it matures, and then goes in your liquidity bucket, and boom, it just pays out periodically to cover your mortgage. Okay? It's kind of a no-brainer way. It takes a lot of thought as far as designing it, but once you have it designed and set in place, it's a great, very efficient, low-stress way in order to make that money work for you. Okay. Now, when we get into the growth bucket over here, that's where it gets down to more what are the different types of stocks, so equities, and the bonds that are aligned with your financial goals. Okay, so this is going to be the asset allocation that we would sit down with clients to figure out from a financial planning perspective what is going to help you achieve those long-term financial goals. Is it a 60-40 mix of stocks, bonds? Is it going to be maybe 30-70? Depends upon your risk capacity, so your ability to withstand risk, the volatility, and your risk tolerance. That's more the emotional. So one is the financial. So purely from a financial perspective, what could you tolerate, or what could you bear, and that's aligned with your goals. But then what allows you to sleep well at night, right? And the beauty behind this kind of structure is if you think about it, if you take a 7-year view of stocks, you can kind of ignore what happens on a daily basis, even on a monthly basis. You have a bear market in equities. Bear markets really only last like 6 to 12 months. Right? And so if you have 7 months of spending between these buckets already planned out, you can kind of ride through that. And so that's kind of the general structure behind how to design this. And if you have income goals, right, this could be the dividend paying stocks, preferred stocks. You could also then look at other types of instruments like master limited partnerships, and then you could look at high yield bonds, corporate bonds. A lot of it depends upon what type of account. Is it qualified? So is it in a 401k IRA where you don't necessarily have to worry about the taxation? Or is it in a brokerage account where it's taxable and you have to be much more tax sensitive? Okay, because in the tax sensitive, that might be more municipal bonds, whereas the corporate bonds go into the qualified account. You would have dividend paying stocks, steady eddies, cash cows in the taxable account, and you might have your more higher flying growth stocks in the qualified account. So very different. That's the asset allocation and location process that we would go through.
So how does a person kind of keep track of this? So if you have money here, money here, how do you bring it together?
So
I don't know if that's a fair question.
Yeah, I mean, if you want to do it on your own, right? One way that you can do it is through oftentimes a brokerage account where they offer a variety of different accounts, and you log in and there's a dashboard, and it shows you the big picture, right? What's your stock, bond, cash mix? But then you dig in. Okay, well, I have this account, this account, this account, this account, right? So that's one way to do it.
But
But
they're
it takes time. You have your
pretty
life to live.
clunky.
It can be very
clunky.
clunky. Yeah.
Okay.
And so we use different tools. So our consolidated reporting, we have technology and reporting to try to make it easier. So we keep track of it, is basically what we do.
Along those same lines, do you recommend any publicly available tools for modeling and/or, kind of comprehensive planning? So, for example, Fidelity has this full view kind of functionality that creates, modeling and time-based visualizations for income returns, those kinds of things. But it's somewhat limited, in my opinion, regarding the puts and takes and even risk changes over time that one may want to do. Is there a comprehensive modeling, kind of an SAP system related to this kind of planning, both for personal and business?
Yeah, so not free, right? And part of it is just because of how individualized you need to get with that model. And so we have special tools to do it because we need to know a lot more individual information in order to properly do the model. So the things that you will find that are free, like the Fidelity, you could go to Vanguard, BlackRock, you will always see the disclaimers on there about this is not individualized advice, but also because it can't give individualized advice, it is necessarily limited as to what it can show. And so you could get broad brushstrokes, but if you want something a little bit more comprehensive, a little bit more detailed, you really do need to sit down with a professional to do it.
Let me just add to that. So we use two custodians, Fidelity and Schwab. So we go out and use third-party custodians. So anybody in this room can do that same thing. And what we do is if people have mishmash, the stuff is all over the place, they have different relationships, you can pull those together, and then it's much easier to report on it, to consolidate your reporting. And then from that point, you can choose to go and hire a financial planner, whomever you would choose to do that with, or go out and find some software online. But if you want either one of those, once it's consolidated and you see it together, you can go through this continuum much easier. So that would be step one in my mind, is try to bring these things together. Go use an independent, world-class, third-party custodian. There won't be basically any fees at all to do that. Again, Charles Schwab and Fidelity is who we use. I'm not promoting them, but those are the two biggest ones. And then once it's together, then you can go through either do it yourself, find something online, or hire a financial professional. And you're running out of time there, Dr. Jacobsen.
So yeah, my alarm just went off at 10:30. So that was pretty much it. I think we covered it just as far as those buckets. And really, if you do want to, obviously, give us a call. We'd be happy to chat about it in more detail. So.
Good. Thank you.